I didn't do the 1, 2, 3.
Yeah, I
So
know. I see
we're
that.
good.
I see that. Let's go. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today I am as excited as ever been because we do have an honored guest here today. We've got the director of the Nelson Nash Institute and son-in-law of Nelson Nash, David Stearns. David, welcome.
Well, thank you. It's great to be with you two guys. Good seeing you again. It's been, I guess, less than a month since we hung out together in Las Vegas.
Mm-hmm.
We did. We got to hang out for the annual Think Take, and we're going to get to that. But before we do, David, if you could just tell our listeners a little bit about yourself, if you don't mind.
Okay, great. I'd love to. Hopefully, hopefully, I'll be succinct here because I know we only have 20 to 30 minutes to talk about IBC and the NNI. But I'm like you said, the son-in-law of the late great Nelson Nash. I married his lovely daughter back in 1979, and that's when I obviously met Nelson. Okay, and those
That's
are
when
days.
Cameron was born, right?
I was I was born in 1980.
There you go. There you go. So I guess my kids are older than you are, whatever. No, but so I knew Nelson way back when, before Infinite Banking was ever even dreamed of. And as we talk today, I can make little comments about how the thing came about from my perspective and how Kim and I were involved in it. I like to tell people that we were his guinea pigs. Okay. He actually used Becoming Your Own Banker on us before he wrote the book. And then we kind of were some of the test cases for the generational wealth chapter in the book. And again, I'll peel back that onion later on as we get into this thing. So, but yeah, no Nelson, we live in Birmingham now. We moved here in 2000, and that's where Nelson lived since 1963. Lived 2 miles down from his house, so he and I spent a lot of time together. I mean, a lot, especially in the last, 14 years when we worked closely together. So, anyway, how's that for an intro?
Well, what did you do before? And what's your role now?
What I did before was I spent 27 years in the United States Army. Is what I did before. I was a lieutenant colonel in the Army. I retired in 2004. I was an aviation branched Army aviator. Before that, I was in field artillery. And so Nelson and I had another, affinity together. He was a fixed wing Army aviator and I was a rotary wing. So we used to go back and forth and badger each other about that. Yeah, that's a huge difference. Okay, fixed wing versus rotary wing. Okay, one is obviously better than the other one. So
of course, yeah.
So we moved to Birmingham in 2000. Got stationed here. There, I was working with a reserve component, and retired here. The intent was to retire in Birmingham, but this is before BYOB popped up in 2000. And so I just transitioned. One day I took the uniform off and started working with Nelson full time. And at first I just handled all the administrative aspect of what he was doing, all the sales of the books and managing his client base and his travels and stuff like that. And gradually, I took over the ownership of, the copyrights and the trademarks and the organization. And I was paying him royalties. And then all he did was talk. When I say talk, he did tons of seminars, right?
Yeah.
And Nelson's greatest joy was to meet new people, to travel to meet new people, and tell them about IBC and just share with them. Okay, you guys know that he was a solid Christian, and he loved to share that also, share the good news with people. And so I tried to take the burden of everything off him, so he had the ability and the time and the energy to do that. So.
And you've been leading up the Nelson Nash Institute since its formation in 2013. Is that right?
Well, correct. The three of us formed it, or four of us, Nelson and I, and then Carlos Laura and Robert Murphy, Dr. Robert Murphy. The four of us put together the IBC practitioner training program for licensed insurance agents and also CPAs, Anthony. This is aimed towards you too. And so we put together this training program because the insurance industry back in 2012 was still concerned about all the mavericks out there doing infinite banking. And so three companies said, listen, we really want to embrace what you're doing at the corporate level, but we want a standardized training program that's sanctioned by Nelson Nash, so we know everybody's doing it the way he wants them to do it. And so Nelson and I and Carlos and Robert Murphy got together, put together a joint venture, and that included the course and the membership. Okay, for those individuals that pass the course, they have an annual membership as IBC practitioners. And then from that, we said, well, this platform needs to sit somewhere. So we put it into the Institute. We created the Nelson Nash Institute. And we named it after Nelson because the whole course is built upon Uno book, plus also built on Carlos and Laura's book, How Privatized Banking Really Works. And so we wanted to pay homage to Nelson with the course and homage to Nelson with the Institute. That's why it's the Nelson Nash Institute. And which, it's been percolating now for 11 years, 2024, and it's still going strong. I have 3 interviews scheduled for this week for new candidates who want to become practitioners. And again, the insurance industry wanted it because they wanted something that was going to define what this looked like in the insurance industry, what infinite banking concepts looks like. Okay, what kind of platform is it built on? And when I say platform, I'm talking about an insurance contract. What does that look like? And how should it be talked about? What are the do's and don'ts about using proprietary software in public? What type of policy design leads to what type of outcome, things like that. And so when we put the course together, we did it in conjunction with 2 insurance companies. Their actuaries work with us, and their legal departments work with us, and that's how it came about. So,
how many practitioners are there?
Right now we have, I'd say active practitioners about 320. Okay. And we have probably active 150 students that are in some form or fashion in a mentoring phase or some sort of training phase. We initiated the mentorship program in 2015, and we did that because, hey, our course is a great course, but if you're not doing it, what does it mean, right? You got to do it. And so most individuals that come to the course come with a mentor, or we assign them one. So when they finish the training, they actually work with a mentor in live cases. Okay, so once that mentor says, hey, this individual is grasped the fundamentals of this stuff and how they relate to the information to the public, how they design policies that are congruent with that individual's expectations, and then that mentor tells us that individual is ready to go, and we let them join the Institute as a member, and that's when they get posted on the website for the public to use. So
now, fortunately, I joined as soon as it was available, and
right.
At that point, in essence, I mean, it's been a long time ago, but I know that there was a test and a fee and a code of ethics. But you guys have expanded it since then. So what all is entailed? What does someone need to accomplish to become certified?
Well, in fact, there's two things. Today is one way, and after April 1st, there's going to be some more things that we have to accomplish.
Well, let's talk about April 1st then, since we're almost there.
April 1st is you're going to have, if you're a new student, then when you come in, you're interviewed, number one. Okay, we interview everybody who's coming in, regardless if we know them or not, and we want to make sure that they're doing this for what we think are the right reasons. Okay, we don't want individuals who just want to use the website to generate leads. We don't want individuals who just want to take IBC and make that another tool in their toolbox, because we think IBC is fundamental to everybody's financial well-being. Okay, it's a place where wealth resides, and you can launch everything out of that wealth. So we interview folks, are they like-minded? Okay, number one. Plus, are their expectations going to be met based upon what their goals and aspirations are? And then we accept them, then they have the ability to enroll in the course. Okay, they'll complete the course, which is an online self-paced course with a proctored examination. And then when they complete that course, they'll have 1 year, 1 calendar year from the date they graduate to attend a live 2-day coaching session. And we're going to do those on a quarterly basis. They're going to be scheduled throughout the United States and Canada. And they attend, again, 1 year to do it. They can pick a quarter, whatever's more convenient to them, whether it be time-based or location-based. And they attend it, and we teach them in high detail how to use Nelson's book. Okay, what it really means, what the nuances of the book mean, what Nelson was trying to impart about this, what's important for the clients to understand, and how to use the book to generate leads, all stuff like that. And so when they complete that thing, then they're trained up. Of course, they'll have a mentor requirement also. In most cases, some people won't have a mentor requirement depending upon their experience level with IBC in the first place. And so that's that. So it's going to be a 2-phased approach: online course and then a live 2-day coaching session. Okay, and we're going to limit the size of those so people get hands-on training. And we're going to, like I said, we'll do those throughout the United States and Canada once a quarter. And we're also changing a little bit. The agreement that we use now as a contract for our practitioners is going to be more robust. We're going to put a code of ethics in there so it's well defined, the do's and don'ts, and what we expect our membership to how to perform in public, and the best way to be a collaborative practitioner. And we're also going to beef up our intellectual property do's and don'ts section also, because as you guys know as well as I do, the term infinite banking is becoming a generic term out there, and people are using it for all the wrong reasons. And so that'll be cleaned up, and we can talk about that in more detail later on if you'd like to.
Okay.
There's 2 things I heard, and there are 2 notes I made. One was, what was the demand that you've seen for practitioners over the years? I assume it's been increasing, right? You've been overseeing this last 13 years. What does that look like?
Yeah, I mean, it's definitely increasing. I mean, in the old days, we had to spell IBC out for everybody what it really was, because nobody understood.
I get it,
no.
David.
I mean, it was like beating your head against the wall. Now people are, I mean, I have people out there now that are counterfeiting, becoming your own banker and selling it on Amazon.
No way.
Okay. I mean, how cost effective is that? No, I got 2 copies behind me back here that if somebody says, hey, this copy looks flaky that I got from Amazon, it came, cellophane wrapped and it looks weird. I go to the same seller, I buy it, and then I immediately do a brand registration takedown on Amazon. It's just like, so, I guess that's flattery when somebody actually copies the book. But it's the same way in TikTok, okay, and YouTube. People are imitating it. People are taking little bits and pieces of it and sensationalizing it, and all it's doing is confusing the public. And the public will come back to us, and they'll say, "What do I do?" I said, "We'll talk to one of our certified IBC practitioners, because we know who they are. We know what training they've gone through, and we know what their do's and don'ts are. If they're doing something wrong, then they're not going to be affiliated with us. Where if these TikTok people, some of them don't even know how to spell it correctly, much less use it with the correct policy construct."
No, and oftentimes I feel that they're overselling it and they're exaggerating the results. And what I say on TikTok or social media, some people say infinite banking is this amazing thing and it's going to cure all your financial woes. And then some people will say it's the worst thing ever. I mean, to be honest, it's somewhere in between, right?
No.
It's not some magic product that's going to solve everything. There's still some things that you need to do, and there's some effort, but this is a great product. And when used properly, can really help you achieve your financial goals, particularly the legacy goals.
Exactly. Hey, if it sounds too good to be true, guess what? It's too good to be true, right? I mean, anything worthwhile is hard work,
mm-hmm.
and it takes a long time to get it right. And everybody's pushing, like, IBC, you know, here's my contract. I bought this and I got $35,000 cash surrender value. See that car there? $35,000 car. And I own it now and I don't have to worry about it and blah, 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 blah. It's like, well, tell me about how you're going to repay that loan.
Yeah.
Yes,
Thank
you know, stuff like that. But, you know, and again, it's not about one policy. It's about fill in the blank, a system of policies.
Yeah.
Right. Mm-hmm. You know, you build them. You build them because number one, you got more insurable interest. You're spreading the wealth out there. You can insure more than just one individual if you have the ability to. Number two is you have flexibility in loan repayments over multiple policies. I mean, it's just, you know, a system of policies is definitely the way to go, you know. So
couldn't agree more. I had a question for you along those lines. Is I've heard other, I think practitioners reference this. I've never heard it from you. So I was going to ask you, David, is that they've referenced Nelson making a comment that kind of later on in life, he had approached you guys and said, do you guys have loans on your policies? Or I hope you have loans on your policies.
No.
Yeah. Is that a true story? And what was the kind of essence of that?
Yeah, that's a true story. Like I told you, Nelson and I used to hang out together a couple hours every day. He used to come over here every morning and have coffee. But anyway, he came over one morning when he had a cup of coffee, sitting here, and he asked me, he goes, what's your loan portfolio look like right now? Your policy loan portfolio? How much money do you owe to the insurance companies? And I'm thinking, oh no, I'm going to get lectured because I'm not repaying my loans. I'm not being a quote unquote honest banker.
Stealing the peas.
I'm stealing the peas. I said, it's about $500,000. And he goes, oh, good. I went, what do you mean, oh, good? He goes, you know, you need a place for windfalls. Okay. So that's like, you know, we have five simple rules of IBC. Well, there's going to be 6. And the 6th rule is have a place for windfalls, because if you don't have a place to put money, you're going to blow it, quote unquote. And I said, well, what are you talking about? He goes, listen, when I pass, your wife's going to have, you know, a windfall, and you need a place to park that money, or you're going to blow it. And you know, the best place to park it isn't premium, if you think about it. But that's a lot of premium to park $500,000 somewhere. You know what I mean? Mm-hmm. So if you have a hole, then you fill it up with a windfall, and then you can work on future premium. So that's what he was talking about. And the closer Nelson got to passing, the more, because it was personal for him, obviously, because he was in the by that time in his life, he was in the mode of you know, preparing his wife to be a widow, and preparing his family, you know, to live, you know, without him, and a part of that, it was to put the death benefit somewhere, because you know Nelson owned 45 policies at one point in his life, and when he passed, I think he owned 22. He and his wife. Mm-hmm. And then after he had passed, there were still like 17 in force that were owned that he'd given to other individuals in the family. They owned, and that's part of the generational wealth transfer. It wasn't all death benefit; it was also transfer of living, breathing policies that were percolating along, just, you know, compounding every day. So. But anyway, that was the genesis of that comment.
Awesome. Thanks for sharing that. David, we interviewed Anthony's son, Chad, several weeks ago, and he's a young man now, right? He's late 20s, I believe.
No, dude, he's 30.
Oh, sorry, Chad. He looked young. He had shaven, right? The point of this is that Chad had been associated. He'd been around IBC for a very long time, and one of the things that he mentioned was there's kind of an aha moment for him. Like, man, I realized how important this was. And before I really didn't understand it. You'd mentioned that you met Kim or married Kim in 79. Did you have that same experience, right? Was there a time where you really didn't understand it, and then maybe one day it clicked for you, or what was your experience?
Yeah. Well, there was three experiences. One was in 79, one was in 92, and then one was probably maybe 6 years ago, whatever. So three of them that kind of took me through the whole thing. The first experience was the life insurance experience, the whole life experience, because I was never introduced to it, like most people aren't. When I was a second lieutenant in the Army in 1979, I had SGLI, which is the group life insurance, for the military, and that's that was like $300,000. That's all you need. Well, the first time I met Nelson was when Kim and I picked him up at the airport when he flew in for a wedding.
It's like that was the first time.
Yeah,
huh?
that was first time, man, because I wasn't smart enough to figure out that you don't marry somebody's daughter, especially if they're from Alabama, unless you visit the family first and get checked off, and then you ask for her hand in marriage. I didn't do that. I was a military guy, number one. I was from a Yankee, number two. And so we picked him up at the airport, and Nelson looked at me, and I was like, obviously I was very nervous. I'm reading my future father-in-law, and he just looked at me and we shook hands. He says, "Boy, we got to talk."
Oh man.
Okay, Anthony, can you hear that? Boy,
Yeah.
we got to talk. It was like, gulp. Oh, yes, sir. And so like that evening, I think later on that afternoon, we're sitting down at a table. He whips out his portfolio. These insurance guys carry around these little leather things. Pulls out this piece of paper, or actually like 6 or 7 pieces of paper. And he says, "Sign here." And so it was a whole life contract. So,
well, David, so if you meet him for the first time and he's like, "Boy, we need to talk," and then you don't talk for like hours later, I got to imagine your kind of mind's a little bit wandering on what he's going to say or do.
Yeah. Well, we were talking about just catching up on, getting to know each other. And then as soon as we were by ourselves is when we did the signing applications and stuff like that. So anyway,
so you signed he had you sign an application on your wedding day. Is that correct?
The day before.
Day before. Okay.
Day.
Smart.
Yeah.
Smart. Okay.
Yeah. Day before. And of course my wife was a beneficiary. So there you go. So that was number one. Number two was in 1992. We had just moved to Savannah, Georgia, or we're getting ready to go to Savannah, Georgia, and we're going to buy a house. And I had to put down 20% for the house, for the mortgage, the conventional mortgage. And it was about $20,000, I guess. And so I called up Nelson and said, "Hey, listen, can I get a policy loan for $20,000 for a down payment on a house?" He goes, "Absolutely. I'll have the check in the mail, this week." And then, and so I deposited my checking account and signed a contract for a house, put down 20%. And they said, "Where'd you get the money from?" The mortgage broker. "Where'd you get the money from?" I said, I didn't want to tell them where I got the money from. If I have to borrow money for 20%, are they going to think I can pay the mortgage back? Right. And so finally, Nelson said, "Don't worry about it. It's a different pot of money. Okay, don't worry about it." And so I said, "Well, I got it from a life insurance policy loan." They said, "Oh, you should have told us that before. That doesn't count because that policy is collateral for the loan. That's not a loan in conventional terms, looking at it from a real estate perspective like this." And so the light got a little bit brighter when that happened. I go, "Wait a minute, something's different here, right?" So this is different kind of money. This is hard currency. It's not fiat money. It's since the policy is collateral for this loan, and I own the policy, then it's not like they're going to repossess my house. So, wow, this is different. Okay, so the third light came on when I was preparing for one of our think tanks that we did. I guess it was 2015. I don't know if you're there or not, Anthony, but I did about a 15-minute little presentation where I threw up a slide. It was a spreadsheet of all the policies that Kim and I owned.
Yeah.
Okay, remember that? And I said, "Listen, we talk about IBC all the time. We talk about all these great illustrations. Okay, man, look how great this is going to look. 5 years, 10 years, 15 years, 20 years." I said, "Let me show you what it actually does look like from my perspective. And these are the policies that we own. We initiated a whole bunch of them ourselves. Some of them I received as gifts from Nelson, passing down. This is what it looked like. Here's the date when they were issued. Here's the face amount. Here's the premium. Here's the insured. Here's the owner. Here's the beneficiary. Here's the company. And oh, by the way, here's the life event that drove the policy. Either a new child was born, or I got a raise, so I could afford more premium somewhere, so I jammed a new policy or whatever. And it was like, and then the more I looked at that and talked about it, and looked at things like how powerful the PUA was. Oh my God, when you can actually see it in relationship to the base build. The face amount is this nice number over here, nice even number usually, and then the current death benefit in most cases was twice as much, sometimes 3 times as much, right? Mm-hmm. I mean, and so that's history, that's real. And then I'd update that every year. And so I did that for you guys so you could see it, but I think it did more for me than it did for you, because it's like, wow, I mean, this is amazing. And when you have we have all those policies all in one spot, and you can see it, and it's almost like Monopoly. You got the board in front of you, and you can start coming up with strategies, the best way to manage your loans, manage your payments. You always have room to put more money in these things if you have more than one policy, right? So those are my 3 events: 79, 92, and 15. That's what. And here I am today, thinking about. My wife keeps saying after the think tank, she looked at one of the, James did a presentation on that case study he did. Mm-hmm. She looked at me and said, "We need to buy another policy." We need to buy another policy. It's like, gee, okay, that's good to hear from that. Good for you. So,
now, David, I'm curious. So you took a loan to buy a home from Nelson. Did he charge you an interest rate, or how'd that look like, that loan process?
It was, 92. It was not like, okay, here's a amortization schedule, sign it. Okay. No, it was like, here's a policy loan. You're responsible for paying it back. And to tell you the truth, we back then in 92, we probably had 6 policies, maybe, or 7. And Nelson had 3 or 4 or 5 on us also. Kim and I, and we had 2 kids back then. And I don't even know where that $20,000 came from. I don't know which policy it came from. I really don't. But I do know that we built in a repayment schedule. We developed it ourselves. Okay, what we could afford to pay on a monthly basis. Okay, but back in 92, it was not as formal as it is now. Now it's like amortization schedule, contract. The whole 9 yards. So if they don't pay it back, then they get their car repossessed by their mother.
Yeah, Nelson, a great man. He wasn't a CPA, so that's why he didn't have maybe all of the everything documented.
Nope.
David, I'm curious, how can you speak on a more personal level? I know IBC has affected you in so many ways. But personally, financially, how has it affected your immediate family?
It's at first it's very painful because I was on a salary. My wife wasn't working, and so every time Nelson came over with his portfolio, here's our, like, oh no, here he comes again. He goes, you need to buy another policy, but whatever. It's like, oh, I can't afford it. No. But anyway, like nowadays, the house I'm living in now, we bought it, and we tore it down and spent. This is back in 2010. We spent about $500,000 on this house, redoing the whole thing from the ground up, all policy loans. Every one of them. Okay. And we were paid all of them within 5 years, $500,000, because we had a system. Okay. And the system was in place, and we managed it correctly. And so we haven't gone to the bank for anything for the last 15 years. Because I think, well, more than that. I think the last time I went to the bank was we mortgaged on the house, 2003 or 4 was the last time we saw a bank. We haven't. Every car we buy is out of a policy loan. Okay, every single one of them, and we finance kitchens. My daughter did a kitchen in Montgomery, financed it for policy loans. But my other daughter did all her bathrooms, all policy loans, cars and whatever, policy loans. And the kids the kids every month, man, it's automatic repayment schedule hits the bank account, ka-ding, 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 ka-ding. And, just, it's like clockwork. And so there is no financial stress, okay, for us. Because it's cash flow. Okay. It's all about cash flow, and it's all positive cash flow. So, I mean, the only thing we pay out of pocket is utilities, insurance, and just general maintenance on the properties and the vehicles and stuff like that. So, I mean, it can, I call it like lifestyle. IBC is a lifestyle, because if you get it right, and if you get it to the level where you can finance everything in your life, not just your major purchases, but everything, and then you manage that correctly, then you have peace of mind. If you have a setback, unemployment or whatever, then you step back off your loan repayments for a while until you get back on your feet again. But it's peace of mind. There's no doubt about it. So
hard to put a price on that without having that stress.
It is unbelievable. You can't do it overnight, obviously. I mean, some of these people, I guess they can drop these $600,000 annual premiums and whatnot, but we never could. I mean, our stuff was all small. We did what we could afford, and but it's hey, it really is wonderful. And let me make a caveat here. I didn't mention this when we first started this thing, but I'm not an insurance agent. Okay, I am not making commissions on anything. Okay, I'm not selling my family policies. I am a consumer of IBC, and I'm probably stupid for doing that way. I can probably make a heck of a lot more money, both managing my own portfolios plus selling to other individuals. But I am a consumer of IBC. I'm the director of the institute, and own all the trademarks and copyrights and all the books and all that other stuff like that, like I mentioned. But I consume insurance. I don't sell it. Okay,
David, I appreciate that on a couple levels. For one, you're making that sacrifice because you could make some. You're Nelson Nash's son. Like you could promote that and leverage that, but you don't. But also, that adds credibility to you and what you say, and to the institution, knowing that you are independent.
Yeah, I mean that was good or bad. That's the way it was, and that's the way we stuck with it. So that's the bottom line. So here we go. I mean, if I was an agent, I'd be buying this stuff. I'd be buying a policy every month, man. If I was an agent selling this stuff to myself, no doubt about it. But
David, early on, you mentioned that you and Kim were kind of guinea pigs on the generational wealth side. What did you mean by that?
Well, if you go to the book, when I say the book, I'm talking about Becoming Your Own Banker.
Have you read it, Cameron?
No.
Wow. Nice.
No, if you go to if you go to the book and you go to the chapter on even distribution of age classes,
yeah,
and you look at those illustrations, those whole life 100s, those policies, net premiums are $2,000.
Mm-hmm.
You look at the PUA and the base. Those policies are what we bought on our children, and Nelson bought on his grandchildren. So Nelson, when he wrote that chapter, he would buy a $2,000 premium, just constructed pretty similar to that, on the grandchildren. And the company that those illustrations were built on is the same company that we bought the policies on those kids for. Mm-hmm. So we actually did that chapter. We're doing it now. We own 2 policies on each of our 4 children. Nelson bought one. We bought one. We have all of them now, and it's the same. It's the same as those illustrations. Of course, they look a lot different because we've been using them, mm-hmm. And funding them. And so when I say we're the guinea pigs, we actually did that chapter in real life. Okay. Same company, same premium level, everything like that.
No, David, we don't need to name the company, but do you recall if that's a direct recognition or non-direct recognition company?
It's a direct recognition company.
Okay. So, because I know there's a lot of talk out there. Do you do direct or non-direct? And the examples in Nelson's book were a direct recognition company. And the most important thing is, go ahead, David.
I still don't understand it, and I'll mention the company if you want me to. But they do dividends. I've been told they do dividends different than other direct companies, because we have 2 identical policies on my son Robert, 2 identical policies on my son Taylor, and whenever we did loans, we intentionally used one policy and left the other one alone. Mm-hmm. And for the most part, when I say for the most part, the cash surrender value death benefit for the policy that we actually use for loan activity is higher than the one that we didn't do it for a direct recognition company. And we didn't. It wasn't like, both. It wasn't like equipment financing where we didn't pay the PUA on policy A and we did the PUA on policy B for loan activity. No, it was like each policy was funded at $2,000 a year, base and PUA, and the loan one was paid back according to the loan schedule issued by the company. Okay, it's 6.5% interest or whatever it was, and if we get more money there, we would, but typically you couldn't get any more money in it. But the policy of the loan activity is a higher cash surrender value death benefit than the one without, and it's a direct company.
And David, I do know you try to be independent on, particularly on how we design these policies, mm-hmm. but there's been a lot of talk about a split, and then this 90-10. Does the Institute have a stance on splitting?
We don't want to tell everybody how to do it, because it's really, like I said earlier, built upon what the best design for that client is.
Yeah.
But I'll tell you right now, do you call them 90-10s or 10-90s? What do you call them?
90-10.
90-10s or whatever.
Okay, good. Okay. So a 90-10 might work for somebody, okay, but why do 90-10? Just do a single premium, get it over with, okay? But I mean, a 90-10, if I'm looking for a 6-month or 1 year or 2 year cash flow and get it over with, then maybe 90-10 is a perfect vehicle for me, okay? But if I'm thinking long term, if I want to use this thing for I don't know, 10, 15, 20, 30, 40, 50 years, I don't know. And if I want to have something that I can pass to my next generation, either death benefit or actually transfer ownership of the policy, then a 90-10 ain't going to work, because the engine on these whole life policies is the base. That's the engine. That's what builds year upon year upon year upon year upon year upon year. And the PUA is, you have 90% cash surrender value year one, but in most cases, you're going to have to reduce the PUA in year 3 or 4. You got to reduce it again in year 6 or 7. I don't know. And so by the time the thing is really starting to generate and accumulate money through uninterrupted compounding, your base is going to probably be either equal to or bigger than your PUA, because you have to reduce it so much over the course of the policy. Again, that's a supposition on my part, because I'm not looking at any illustrations now. But they're stupid, and the reason they are is because the client is looking at one thing and one thing only: the bigger bang for their premium dollar in year one. Okay, and not fully understanding what's going to happen in year 7 or 10 or 15 or 20. Okay, and oh, by the way, these policies are going to be razor thin, quote unquote, which means you'll never be able to get any more in scheduled PUA in the policy. And oh, by the way, they'll probably eat up most of the insurability with a term rider on top of that. So you'll be stuck if you want to, if you figure out that, okay, this is not what we really want. Guess what? You got a 10-year, term or 20-year term on it or whatever. So you have no more insurability left. So you got to go find somebody else, So anyway, that's my view on 90/10s. They might be work for somebody else. Oh, by the way, another good argument against for 90/10s is it gives the policy owner more cash surrender value, because the insurance agent is making a small commission, right?
Mm-hmm.
I mean, come on, these people, they're working their tailbone off, and they should get paid for what they're doing. And what they're doing is giving you a policy that's best for you, not, the most cash surrender value in year 1 or 2 or 3 or whatever it is. So anyway, that's my soapbox for today.
I think we can summarize it here. You'd mentioned that Nelson had around 40 different policies he owned personally.
Right.
How many of those were designed 90/10?
No, well, none of them.
Okay.
I mean, he had a lot of base policies that were pure base.
Mm-hmm.
Most of the most aggressive policies he had were maybe 60/40s. And plus, I have 50/50s, 60/40s. I have some policies where I let the PUA rider close, so now they're all base because I didn't know what I was doing in the early years. There you go. But no, 90/10s. There's only one thing worse than a 90/10, and that's an IUL.
David, that might be one of the first jokes I've heard you say. Another thing people don't realize is that higher base that affects the dividends. The more base you have, the more you participate in the dividends. And right now, when we're in this low interest rate environment, those dividends are small. As we start seeing inflation rise and those dividends increasing, the higher base is going to earn more of those tax-free dividends.
Right. And so some of the best policies and best companies out there are the ones with the higher guarantees, I think, because that contributes to those big dividends in the base also. So, but hey, listen, as well as I do that interest rates are going to rise, and it's not automatic with these insurance companies how that affects the dividend, because they have these long-term investment portfolio. So it takes a little bit of lag there, but these policies are going to start generating larger dividends eventually, I think. So whatever, but yeah.
David, we mentioned this before we started, but I noticed you're proudly displaying the first 5 editions of Becoming Your Own Banker back there behind you.
Hey, can you see that?
Yeah, I can. Yeah,
I'm jealous. Actually, I was thinking about that would look pretty cool in my office. That I would love to get my hands on those older editions.
Let me do a shout out to Jason Loeb for that. Okay, he gave that to Nelson Nash, and so I made sure I curated all Nelson's stuff. All this, top of the table stuff and all this, first edition and all the draft books and all the stuff like that. So that's part of the Nelson Nash legacy that's going to go somewhere eventually. But yeah, that's edition 1, 2, 3, 4, and 5.
That's pretty cool
up there. Yeah,
that is cool. The question I had for you in regards to that was kind of looking back, whether it's professionally or personally, is what are you most proud of?
Probably, probably that we've stayed consistent to message. Number one, we haven't, both personal and from the organizational standpoint, we haven't deviated and gone somewhere chasing some new fad or some, something that's going to make us more money. Okay, that's probably the top business success that I say, and I'm also proud that we brought my daughter on board just recently as our director of marketing and communications, because we've seen and we know that we have to have a bigger presence out there. Okay, so that's her mission, is to get the word out there in every facet that we can, so people understand what the Nelson Nash Institute is, what we're trying to do, and and we want to be a positive force out there, not a negative force. Okay, we're all about abundance. Okay, and so that's from a business standpoint, that's what I like to talk about. Personally, I told you Nelson was a big Christian. He helped me become much more mature in my walk with Christ, and so I'm proud of that, and I'm proud that I don't hide behind it. Okay, I can lead with it if I want to, because I think it makes a world of difference. It really does. I think it's a grounding that we all need. So anyway.
Well, awesome, David.
Yeah. David, coming from just a practitioner and attending Think Tank just a couple weeks ago, I was proud of your organization just for filling that room. I think there was almost 300 people that were there. Mm-hmm. And I mentioned this in a previous podcast, but man, I remember when I first was introduced to infinite banking, there was just a small group of people that were passionate and knew it. And now through your efforts in the organization, you've introduced it to a lot of people. So thank you.
Yeah. Thank you. You're welcome. Yeah, it was good. It was good. It was a great crowd, a lot of energy. We're trying to again reach everybody, okay, through all different facets and all different stages of life. We're trying to get as many young people involved as we can, because they're the ones that are really going to get this thing done correctly. And so that's our whole mission. So
awesome. David, really appreciate your time, and thanks for coming on today.
Well, I enjoyed it very much. You guys take care of yourself, and look forward to spending some time with you again.
Looking forward to it, David. Go make it a fantastic day.
Take care.
Okay. Thank you.